If you're in your late 50s or 60s and thinking about long-term care, the question isn't, is insurance good or bad? The real question is, which risk stays on my balance sheet and which risk do I transfer? By the end, you'll know a simple way to size your personal care reserve, when self-funding makes sense and when to consider transferring part of the risk. Here's the perspective shift that helps everything click. The golden policies people still talk about were priced in the 1990s for a world with higher bond yields and higher lapse assumptions. People kept coverage longer, started living longer, and yields fell. Premiums rose, many carriers exited, and today, most new policies come from a concentrated group of writers. Hybrids grew because families wanted benefit certainty, and insurers preferred designs that were easier to price with today's realities. So what does that mean for you right now? You don't need a magic number. You need a clear reserve sized to your location and preferences, then a calm decision about whether to self-fund all of it, transfer a slice, or do a mix. Let's name the emotional driver out loud. Many thoughtful savers don't want to become a burden on their kids. Dementia tops the list of fears, and the caregiving load is real. Millions of family members provide unpaid care every year. Planning here protects relationships as much as portfolios. Here's a 3-step way to get clarity fast. Name your preferred setting: home first, assisted living, or nursing care. Preference drives cost more than any spreadsheet tweak. Price it locally. Use today's medians for your area to anchor the plan. Nationally, for 2024, assisted living was around $70,800 a year. Nursing home, semi-private, around roughly $111,325 a year. And private room would be around $127,000 a year. Home care medians sit in the same ballpark as assisted living. Costs have been rising, so it's important to size your care reserve. Pick a duration that matches your family history and comfort. 3 to 5 years covers most scenarios. So as an example, assisted living at $70,800 for 4 years equals $283,200. That's in today's dollars. Nursing care at $111,000 for 3 years gets you north of $333,000. So that's your starting reserve in today's dollars. Where's the line in the sand, though, for self-funding? There isn't a universal asset cutoff, and chasing one keeps families stuck. Use the care reserve instead. If guaranteed income plus liquid assets can carry that reserve on top of lifestyle spending and survivor security, self-funding works. If covering the full reserve would strain the plan or the survivor, transfer some of that risk to an insurer. This is guidance, not a product pitch. So who tends to self-fund? Typically, it's families with strong guaranteed income, ample taxable liquidity, and a desire to keep flexibility. Often earmark a dedicated care bucket equal to the reserve. Studies and industry snapshots show only about 7 million Americans have private long-term care coverage, which means most households de facto self-fund or rely on Medicaid after spend down. The ones that tend to insure or blend are couples who want survivor protection and leverage on dollars for a long claim tail. Solo agers who value claim coordination and benefit certainty. Households that want benefits to go somewhere even if care isn't needed. This is where hybrids resonate and why that market has grown. Here's a few important realities to ground the conversation. Medicare is health insurance. It doesn't pay for custodial long-term care. That's the gap we're solving. Medicaid is the safety net after assets and income are within strict limits. There's generally a 5-year look back on transfers. State rules vary. that can delay eligibility if assets were gifted below fair market value. This is legal planning territory, so involving an elder law attorney before moving assets or trusts is very important. Also, supply and pricing pressures are real. Senior housing occupancy has been rising with constrained new construction, which supports today's higher rates rather than pointing to oversupply. Plan with that in mind. A quick story to make it real. I'll call them Anne and David, early 60s, mortgage gone, reasonable pensions. Their worry wasn't premium cost, it was the survivor. We priced care, where they live, set a care reserve covering 4 years at home plus a year in assisted living, and asked a simple question: which slice do we self-fund comfortably and which slice keeps us up at night? They split the risk, dedicated brokerage dollars for the first years at home, a modest hybrid designed to protect the survivor if care runs long. After, it was one page, one reserve, clear roles for each dollar. And if someone wants to spend down and use Medicaid, that path trades choice for affordability. Quality varies by facility and region. Some communities accept Medicaid after a private pay period, others do not. If leaving a legacy is a priority, remember the look back and need for early, state-specific legal advice on irrevocable trust strategies. This area belongs with an elder law attorney. Your role is to size the reserve, stress test the plan, and coordinate with counsel. As mentioned earlier, the top clinical drivers families mention are cognitive decline, especially Alzheimer's and other dementias, frailty after a fall or surgery, progressive neurological conditions such as Parkinson's, dementia risk, and caregiving burden are why many families choose to name a plan now rather than leave the logistics to adult children later. A calm framework you can run once a year is to name the setting of, where do you prefer to receive care first? Price it locally, update today's medians for your zip code, and then set the care reserve 3 to 5 years at your chosen setting in today's dollars, plus an inflation cushion as well if you're earlier in retirement. Assign the risk on purpose. Self-fund if the plan carries the reserve without stressing survivor security. Transfer a slice with traditional long-term care for pure leverage or a hybrid for benefit certainty. Blend when that fits your goals. The gentle next steps are, if you want to see this in your numbers, I'll pull your local cost, size your care reserve, and show side-by-side self-fund, insure, and blend. And then you can pick that path that gives you confidence. So same life, same goals, just a plan that names the reserve and assigns the risk leads to a more durable retirement and steadier family dynamics.